when the companies, they do business, they need capital. Okay. Now, capital can be, contributed by the promoters or by the shareholders in form of shares. That means it can be a share capital, or companies can borrow money. Okay. Whenever the companies, big companies, they require more and more money, then they take loans from the banks, financial institutions, or they float their debentures or bonds. Okay. So mainly there are two kinds of capital. Okay. Either it's called, the equity or debt. And there is a third one which is called the hybrid, which has common features of equity and debt, like preference share or convertible debentures, which you buy them. They are like bonds or debentures to begin with, and then you can convert them into shares at a later part at a price which is fixed at the time when these bonds are issued. Okay, so there are three kinds of capital sources a company can raise money broadly. One is called the equity, another is called the debt, or third is called the hybrid. Examples of hybrid are preference shares or convertible debentures, and there can be many others. Okay, fine. So this is the capital structure. Now the question would be, what kind of capital structure a company should adopt? Okay. Now, if you have more of equity, because equity is a costlier source of capital, because the equity shareholders, they expect a return upward about 15% from any company, and the company is more riskier, so their return level may go to about 20 or so, or more than that also for some companies. So it all depends upon the riskiness of the company. And then debt is a cheaper source of finance, where you pay a lower rate of interest. Okay, you pay, that's an explicit source of taking money, where you pay either 9%, 10%, 11%, depending upon your credit rating. Now, because it is cheaper in one way, because there is a tax deduction also given to you, companies can claim this as an expense, and their tax liability goes down. Okay, so virtually, if a company is paying 10%, interest on loan, and if suppose the tax bracket is 30% of the company, usually companies are 25, 30. There are about a couple of brackets in India. So if the 30% is there, then they pay only 7%, because 30% is they get a tax deduction. So it's much a cheaper source of finance. But if you add more and more debt, company becomes riskier, because there is always a chance of bankruptcy. The company is unable to meet out the requirement. Suppose the company is not doing well, company is not making profits, then company has to still pay, service the debt. Okay, and it will consume capital. Out of capital only, from the shareholders' money, the interest will be paid. So it's a risky source of finance. Okay, so in good times, it magnifies the profits of the company, and the shareholders benefit from it. Because suppose if shareholders expecting 15 to 20%, but you are paying only 7% post-tax, kind of a cost on debt, and if you are making 20% on the total capital, so the 13% extra which you are generating goes to the shareholders. Okay, the shareholders' returns magnifies. Have you understood that? No or yes? See what happens. Suppose you have 100 crores of money with you. Okay, you're doing business entirely with your only equity capital. And suppose you're making 20% return on your total capital. Your business is such that you make 20% return on whatever capital you deploy from wherever you deploy. So what will be your profit? 20 crores. And that will belong to the shareholders, isn't it? Now, if you add another 100 crores, okay, because you are expanding your business, and now your capital is 200 crores, and you take a loan from a bank on which you are paying 10%. Okay. Now, but you're on 200 crores, you're still making 20%. How much you make? 40 crores. And how much you pay to the, on a debt, this thing only 10%. So 100 crores में 10 crore आपने दे दिया as a interest. So still 30 crore remaining. For the 100 crores shareholders, they'll get now 30%. So their return will become 30%. Isn't it? I mean, if we don't take tax calculation into picture, tax, will again prop up the magnify the returns further. So earlier they were making 20% return, now they are making 30%. Because they have another additional source of 100 crores on debt, on which they pay only 10%. Okay, but they earn 20%, so the 10% extra which they are earning get passed on to the shareholders. Is that clear? Clear? Okay. Now, but as I told you that it can magnify the returns as well as it can magnify the losses for the company. Suppose the company is making no profits. On the 100 crores, they are making no return. Suppose the situation is bad and company is not doing enough turnover, or the cost have gone up significantly because of commodity price going up or whatever reasons, but they have to still pay 10%. Okay, that is going out of the money of the shareholders. Okay, shareholders are not getting a return, then return goes to negative, isn't it? Fine. So the capital structure should be an optimum capital structure. Okay, fine. If the company is expects to do well, okay, in future, and they should go for debt, because that good times debt will always reward the equity shareholders. In bad time, the debt is going to punish the shareholders. So it all depends upon which cycle of the economy you are in. So you have to design a capital structure, very optimum capital structure, so that you can withstand that ups and downs. Even if you have some debt, but the economy is not doing well, but it's not like you have so much of debt, then you have to service that debt. Okay, so if you have a small amount of debt, okay, we looked at debt to equity ratio of say companies like Reliance or companies like other companies, they are very, I mean, compared to equity, they are very less. If Reliance is putting 1 rupee as equity, they're putting only 40 paisa as debt. It's not that companies put two times the debt and one time equity. It can't be like it can be. It has to be in a ratio which a company can sustain and company can manage during bad times. So designing of a capital structure is very important, and we'll talk about that more. But before we do that, we'll do a question to understand. So just open this Excel sheet which I shared with you. Now this question is already there in your slide also, but I put it in a, okay, if you just go through the slide. So this is the question on your screen. Suppose that a firm has an all equity capital structure consisting of 1 lakh ordinary shares, which are equity shares, at the rate of rupees 10 per share. Company has 1 lakh shares issued, all capital structure. So far they have not deployed any debt. Okay, so they have 10 lakh rupees capital in form of equity shares. The firm wants to raise 2,50,000 to finance an investment and is considering a three alternate methods of finance. So company needs more money. How much? Another 2.5 lakhs. So they are exploring what kind of how much they should get from which source. So they have three options: to issue 25,000 ordinary shares of rupees 10 each. That means they go for equity shares, finance this new investment through an equity source, or to borrow 2,50,000 at 8% rate of interest. Or the third one would be to go for an hybrid capital, which is a preference shares, and again they will be issuing 2,500 preference shares of 100 each at 8 rupees. At an 8% rate of dividend. So these are the three options given to you. If the firm's earning before interest and taxes after additional investments are 3,12,500 and the tax rate is 50%. Now taxes now in India are 30%. So we are assuming here very high tax rate. So if the company is earning an operating profit, for example, the company is already operating and making some profits, so they are making 3,12,500 profit before making any taxes or interest. So this is called EBIT, operating profit. So they make. Find the effect on earning per share under three financing alternatives. Okay. Now the question ends here, but in my slide or my Excel sheet, I've added one more thing. Find the effect on earning per share under three financing alternatives. If P ratio for equity plan is 10 times, for debt it is 8 times, and preference shares it is 7 times, suggest which plan is the best. Now, why I have added it? When the company is all equity, the P ratio of the company is 10. Okay. When the company takes money on debt, the shareholders perceive the company has become riskier. Okay. The shares, the valuation will get re-rated, and the shares will trade at 8 times price earning ratio because the company has become riskier. So shareholders know that company has taken debt. So now they are going to give 8 times. The P ratio will be 8. That means your share will be trading at 8 times of earning per share. So the valuation will come down. As the company takes more and more debt, company becomes riskier and riskier, isn't it? Fine. The shareholder is not going to be very happy about it if they think that it can cause issues in future. So they are going to bring down the valuation of the company. The share price is going to drop in the stock market. In very common language, it will drop. Okay, it will drop, and the P ratio will drop to 8. So that is what the question says. But for preference shares, things will drop further to 7. Okay, so this is the assumption which is given in the question. Okay, so now let's go to the answer here. Okay, now it is given equity financing. Okay, how much? 3,12,000 is the EBIT. Debt financing for all the sources. To start with, this is the profit. Okay, the company is making before the company has entered and taken shares or taken loan or preference shares or whatever. So this is the profit at the time when the company was planning to take additional source of capital. So this is the profit what company is making, earning before interest and tax, EBIT. Okay. Now suppose company has taken a debt. The first is a debt. Okay. It can be equity, financing, and preference share. So what I'll do, I'll just first show here, from this slide. So this is equity. The first is equity, then we come to debt, and then we come to preference. Okay. So this is equity. 3,12,500 is the profit. There is no interest because the company is taking all equity. Okay. So the profit before tax will remain as 3,12,000. Assuming because the company has taken the money, but the profit remains the same. So taxes is 50%. Okay. 1,56,000 is the tax. So the profit after tax will be 1,46,250. Okay. Preference dividend, no, because company has not gone for preference dividend here. Neither for preference dividend nor interest because company has only increased its share capital by issuing more shares. Now the earning available to ordinary shareholders will be 1,56,250, isn't it? And the number of shares will go up from 1 lakh to another 25,000 because company has issued new shares. How much? 2,50,000. So that will translate into 1,25,000 shares. Okay. Just look at this. The company already has, just look at the slide. The company already has 1 lakh shares, the first box. Okay. But now the company has issued another 25,000 shares, the third box. So, abhi jo current situation after, taking new shares, the first option they go for, then the total number of shares will go up to how much? 1,25,000. So if you calculate earning per share, which will be 1,56,250 divided by 1,25,000. So the shareholders' profit, the PAT divided by the share outstanding, the earning per share is how much? 1 rupee 25 paisa. So if you divide 1,56,000 by 1,25,000, which I'll show in the Excel later on, so it is 1 rupee 25 paisa. Okay. Now if the company takes debt finance, okay. Now what happens is that company is going to pay interest. If you look at the second row, less interest at the rate of 8%. So the company has taken 2,50,000 rupees loan, isn't it? On 8%, it comes to how much? 20,000. 2,50,000, 8% is 20,000. So now the profit before tax will be 2,90,000. Tax will get reduced because company has taken a loan. So tax burden will go down to 1,46,250. Now the earning available to the equity shareholders will be how much? 1,46,000. And the shareholders, number of shares are 1 lakh here. The company has not issued further shares, so they have financed through debt. So what will be the earning per share? 1 rupee 46 paisa, isn't it? Now you look at the two options. Which option looks to be better? The second option looks better. It's actually enhancing the earning per share because that is cheaper capital, okay, and it is also tax deductible, so it is boosting up the EPS. Third, preference shares. Now preference shares, what happens is there is no interest, only dividend. Now dividends are not tax deductible; they are just appropriation of profits. Okay, so the company doesn't get any tax benefit. So it will reduce the profit to 1,36,000. If you look at the profit level, it is the lowest in preference shares. Okay, and the EPS will go to 1 rupee 36 paisa, isn't it? अभी इसको समझो अभी हम चले एक्सेल शीट में, you will be able to understand it well how it has been calculated. So which option seems to be better? Debt, because it is boosting up in good times. It is going to reward this thing. So let's go to now the Excel sheet here. So look at this. So here what I have done is I have got 20,000 here. Okay, how we have done 20,000? It is Q1 into U8. Okay, so if I just put this cursor here into formulas and trace this thing, so it is basically it's referring to the here Q1. So it is question 1. Okay, question 1 में हमें जाना है debt financing में. So debt financing, it is picking up from here. Okay, so this is the number which is got. So what I have done is I have just put all the numbers outside. 1 lakh is the existing share capital of the company, 10 rupees, 10 lakh. Then the first option is 25,000 equity shares, okay, of 10 each, 2,50,000 is the money they are going to get. Then 8% when they are raising the money through debt. On 2,50,000 they pay 20%. So it is calculated like this, 8% of 2,50,000, 20,000. Okay. Similarly, when they are raising money through debt, they are again paying 8% dividend. So it will be again same 8%. Okay. So now this column is what? U8, and this column is U9. So what I have done, I have given a reference here of, so U8. So it's picked up from there. Okay, fine. And then again, this is your profit before tax after deducting this. So this is this minus this. Okay, fine. And then this is the tax, which is basically, by multiplying by, 50%, which is coming from here, which is the reference is R11. R11 is here. This is R11, 50%. So I put the tax rate outside and just given a link here. So it is the profit, this profit multiplied by R11, which is 50%. So इसका कितना आ गया? 50% of 2,92,000. Is that okay? Fine. So then, this is the PAT. Then the shareholder earnings are going to be 1,46,000. Okay. 1 lakh outstanding shares, which is not changed. This is 1 lakh share capital तो है ही already. It is given ना, ये देखो. This is the 1 lakh share number of shares company has. Now company has chosen a debt financing, so number of shares not going to change. They are going to remain the same. Okay. So they are going to remain. So first option, the shares are going up. Second option, the shares are remaining same. So we calculate earning per share, which is this divided by this. 1 lakh here, because their equity shares are not changing. Only preference shares are changing. So what we are calculating earning per share for equity shares. Fine. So EPS is calculated on equity shares, not equity plus preference shares put together and preference shares. Okay. Okay. Now, just to give an idea, company can choose, mostly if you look at the balance sheets of many companies, it's 99% equity shares. Okay. But some companies issues preference shares. Okay. Now, equity shares, the dividend is not mandatory. The one thing, dividend is not mandatory. And company earns profit, company can, put that profit into business and skip dividends. If the company has more demand of money, so either they have to take a loan or they can use whatever profits they have earned from their operations, so they don't pay any dividends. So it can be a chance that they don't pay any dividends. Okay, but in case of preference shares, they will carry a dividend. They'll carry a dividend rate. Like in this case, they're carrying 8% dividend rate. So now company has to pay dividend of 8%. If company is profitable, the company has made profits, they would be paying dividend. Now, preference shares can also be called cumulative preference shares, because suppose company has not made any profits. So what the company is going to do next year when the company makes profits, so it is giving two dividends, 8% for the previous year and 8% for the current year. Agar suppose पहले साल में company ने कोई profit नहीं कहा, but preference shares they have to pay 8% dividend. From where they will pay? They can't pay it because they are not making any profits. So company act says that the dividends can be paid only out of the profits of the company. So as per the Companies Act 2013, which says that the company can declare dividends whether to equity shares or preference shares only out of the profits of the company. The company has not made profits, but the shares which have been issued to the public as preference shares, they are cumulative preference shares, which means if the company is unable to pay the dividend, it will get cumulated in the next year when the company makes profit, or in the year when the company makes profit, they have to pay all the dividends of the previous years also. Okay, so that is a big difference between equity shares and preference shares. Equity shares, company skips the dividend. Next year, if company makes profits, it may declare, but this is not cumulative. Okay. But in case of preference shares, most of the time it issues cumulative preference shares, so company has to pay dividend if in the year when they make profits. Okay, or even if they are not paid in past, they will be making up this thing, and they can be redeemable preference shares also. That means, okay, just listen to me. Now there will be another class of preference shares which are called redeemable. That means company will redeem them. Company will pay back to the shareholders. Okay, whereas equity shares there is no such clause. When the people have given the money to the company, that remains with the company forever, unless the company decides for a buyback scheme. Long back, 15 years, 20 years back, there was no buyback. Company had no provision to buy back equity shares of when they have issued equity shares. So the money will remain with the company forever. Company can only pass on the money through dividends only. But the law was amended where, companies were, the companies have been over-capitalized. Company has a lot of money. Suppose, for example, you're doing a business and you have so much of money of equity shareholders, but you don't have money, any expansion scheme or where you can deploy your money. So you're sitting with extra money, isn't it? Which is not generating any. So the companies, what the company is going to do? It is going to deposit in fixed deposit, which is going to earn only 7% rate of return. So to bail out those companies, the Companies Act was amended, where the companies were, can come up with a buybacks, where the companies can even return back the money to the shareholders what they have collected from the equity shareholders. But preference shares, if they're issued as redeemable preference shares, then the company has to pay back the money. Okay, that was the law before also. Okay. So redeemable preference shares, the company can always pay back the money back to the shareholders, which was not there in the equity shares. But now company can pay back also because the law amendment has been there. Fine. Yeah, your question. Now, coming to the question of dividend. Now, in both the cases, for equity shares, the company is going to pay dividend. Okay. Or in case of preference share, they are going to pay dividend. Both are appropriation of profits. But here we have taken the dividend of only preference shares. We have not taken the dividend of equity shares. Is that your concern? Now, since we are comparing the three plans, okay, and the common factor is dividend in all the cases of equity shares, the company may declare this thing. So we are just looking at, we are not taking that at all, whether the company is paying dividend or even the company is paying dividend, it doesn't make any difference because it will come below the EPS calculation. After you have calculated EPS, only the dividend has to be paid. A company has earned a dividend of, say, company has earned an EPS of 1 rupee 25 paisa. इसमें से dividend pay होगा ना? Fine. So to decide which, scheme is better, so we don't have to consider, what the company is doing after company has earned earning per share on equity shareholder. पहले कंपनी ने कितना कमाया per share, that's more important. उसके बाद कंपनी में gave 1 rupee 25 paisa as dividend, it is immaterial. In all the cases, company can pay. So that is coming after the line. Okay, so the decision is rest at this line. Decision तो यहीं पर होना है ना. उसके बाद में कंपनी डिविडेंड equity shares में दे या ना दे, उससे कोई हमारा डिसीजन चेंज होगा नहीं. Have you got it? Okay. Now, dividend is not an expense. It is an appropriation of profits. So that's why I have taken, preference dividend as a reduction from the profits to calculate the EPS for the equity shareholders. वो तो कंपनी को देना ही पड़ेगा, उसके बाद तो EPS कैलकुलेट होगा. Equity, how much the ordinary shares or the equity shareholders are earning per share, it can be only arrived after the dividend has been paid on a preference shares. Is that okay? हाँ, तो वो प्रेफरेंस शेयर होल्डर्स, इसमें शेयर आउटस्टैंडिंग जो होगा, इसमें सिर्फ मैं इसमें अगर लाइन ऐड कर दूं तो और क्लियर हो जाएगा. नहीं, इसमें हम कहेंगे equity shares. Okay, suppose I add to clarify. Only what are the equity shares outstanding? Fine. Suppose you are an equity shareholder of the company. So you want to know how much my shares are earning per share. How much company is earning per share. You have nothing to do with the preference shareholders because they are different league altogether. So for all the ordinary shareholders, they want to know what is the EPS we are getting. So the base is not changing. For them, 1 lakh equity, the new financing was done only through preference shares. So that will not be counted for the purpose of calculating EPS. So equity shares जो है, उनकी earning per share कितनी है, वो तो change नहीं होने वाली, whether you are going to issue preference shares. The number of shares are not going to change. The equity number of shares are not going to change. Is that okay? This was, actually, this is the company when they issue preference shares. Now, for example, company, when you go to a bank, the bank says that suppose you're taking a loan and, they say that if you're taking a house loan, they will be charging 8%. So how do the bank decide about that 8%? And maybe about, today 1 year before you went, they were saying 7.5%. 5 years back, you went to the bank, they were showing 10%. So the rate of interest keeps changing. And it depends upon the cost of the funds of the bank. जो बैंक आज की डेट में फिक्स डिपॉजिट पे इंटरेस्ट दे रहा है, सेविंग पे इंटरेस्ट दे रहा है, उनकी कॉस्ट कैलकुलेट होती रहती है. सो उसके हिसाब से, और अगर सपोज इंटरेस्ट रेट्स आर गोइंग अप, ओके, द इंटरेस्ट रेट्स आर डिसाइडेड मेनली बाय द मार्केट फोर्सेस एंड द कंपनीज, गवर्नमेंट्स आर इशूइंग बॉन्ड्स every Wednesday and they're borrowing a lot of money. So that is the deciding factor. Today, the rate of interest which the government borrowing rate is about 7%. So government is borrowing, which is a risk-free kind of a rate for India, which is around 7%. So now all other rate of interest will be pegged to that rate. The banks are going to charge you 8% on the loan because because all the interest rate will be actually derived from the bond rates of the government. Okay, अगर government ही borrow करेगी 5% पे, तो bank will say will charge you 7% because they can't charge you more. The rate of interest will drop. So rate interest will go up and down based on the market forces. And one of the important figure to look at, what is the 10-year government bond or a 5-year government bond or a 3-year government, what is the rate at which government is borrowing. Okay, so अगर inflation बढ़ती है, so the banks have to raise the interest rate, because now suppose the inflation is going up. Suppose the inflation is 10%. So if the bank says that you give us a fixed deposit rate at 8%, you are not going to give money to the bank unless you get 11% higher than the inflation rate in India. So inflation has gone up, so bank is going to give you more, okay, above inflation, 11%. So when you go to the bank for taking a loan, bank will charge you 13%, isn't it? So rate of interest keeps rising up and down. Similarly, when the companies decide, how much, they are going to reward to the preference shares in terms of percentage of dividend. They look at the current rate. What is the rate? अगर आज की rate में fixed deposits are giving 12%, so the preference shares can't be at 8%. Nobody is going to buy them. People will say that we go and take a FD and earn 12% from there rather than earning 8% from the company. So company will decide at that time they are going to pay you 15% or 14%. That's why you will go to the company and get the money, because company is more riskier than the bank. If bank is paying you 12%, then the companies have to pay more than 12% depending on the credit rating of the company. If the credit rating of the company is very poor, they may even give you 15, 16%. Okay, fine. So the rate of interest decided on preference dividend will be the current interest rate scenario prevailing in the economy and the country. Normally, in this question it is 8%. So that time it was, fixed deposit would be somewhere at 6%, 6.5%. Achha, you are from Hero Group. So one of the company which I was working for, the Hero Group, we have given preference shares to a company, a lot of persons, and there was, Bill Clinton, who was the president of America, he had subscribed to preference shares of a Hero company at that time. Okay, so he had taken preference shares. He had invested around, I think, 25 crore rupees in one of the Hero company at that time, and preference shares were given to him. So in night 8 o'clock, I used to go to Mr. Munjal's house, and we used to have con call with those people, representatives of Bill Clinton, because they would like to know, how the companies, they put a lot of money into the company, so they were worried about the company's future. तो रात आधा घंटा हफ्ते में एक बार कॉन कॉल हो जाती थी उनके पास, तो उनको तसल्ली हो जाती थी उनका पैसा सेफ है, इट्स अर्निंग. Company can issue a bond also, or a debenture. Company can issue preference shares. So why a person will go for a preference shares? Why not for a debenture? So that will be a question. Okay, the question is now here that if the company is into a bad shape, so there is always the companies in a liquidation. कल को कंपनी खत्म हो रही है, बंद हो रही है. Okay, the equity shareholders will get the least priority. Only if money is left with the company, then only the equity shareholders get money. Otherwise, the shareholders can lose almost 100% the capital. Okay, the second in line are preference shareholders. Okay, the least priority is equity shareholders. Then comes the preference shareholders, and then comes, the first priority will be the loans. Okay, now if a company issues a loan or a debt or bonds, so they may say 9%. Sorry, they may say 7%. But if the company is issuing preference shares, they have to give more, because here the chances of your money getting back is less, isn't it, compared to the loan. If suppose company goes into liquidation, so after paying off all the debt, company is not left with anything. Neither the preference shareholders get any money, nor the equity shareholders are going to get money. So preference shareholders, if they are, if you are inducing preference shares to invest in your company, you have to pay higher rate of interest than a bond rate. Otherwise, कोई company में लगाएगा नहीं preference shareholder, क्योंकि they are losing out in the priority list in the case the company is in a bankruptcy mode. Then they are going to get the, after shareholders, their number falls. Okay, first company has to pay all the taxes, government dues. And if the company is under liquidation, company has to pay for salaries, government dues. ये सब चीजें पहले क्लियर करनी है. उसके बाद then comes the banks, who have given loans to the companies, and then comes the preference shares, and then comes the equity shares. Okay. Now, after we have worked on the EPS, we found that debt financing was a very good source of this thing, because it is boosting the earning per share. But the question doesn't end here. The question says that the P ratio is 10 in case of equity. In case of preference shares, it is 8. And in case of, in case of debt, it is 8. In case of preference shares, it is 7. So what we do, we multiply the EPS with the P ratio to get the market price per share. After this financing, the market price of the share in the market will be 12 rupees 50 paisa. There it will be 1170. There will be 954. Now tell me which is a better source of financing? Equity. The things have changed now. Though the earning per share has gone up, in the case of debt, the shareholders are perceiving that risk of the company has gone up. So they have, devalued the shares in the market. The share price has dropped. Okay, assuming that the company can't afford to take any debt. Okay, suppose the company is such that debt can be detrimental to the company because company is passing lot of volatility in the profits of the company. Okay, just hold on. So if the company is very volatile, it is making some products which are only taken when the economy is doing well. When the economy is in bad shape, the people don't even buy their products. So they will have ups and down in earning price per share of the company. Okay, if that is a scenario when the company takes debt, so immediately the shareholders will react negatively and bring down the prices in the share market. And the share price, instead of trading at a multiple of 10, will start trading at 8. Okay, so that means here the earning per share tells you the story that the equity financing is better because here the risk is not making any change in the company. Normally, when the company takes more and more debt, the P rate ratio drops because the company's beta goes up, company's risk goes up. Okay, when the risk beta goes up, the cost of capital equation carries beta. So the expectation of shareholders will be more now because the beta will multiply with the market risk premium and give you a higher, a cost of capital for equity, isn't it? हाँ अर्निंग पर शेयर में देखेंगे तो equity financing is better. हाँ EPS में देखेंगे तो debt financing is better. But अगर हम market price देखेंगे कि how the market price is going to react, then we see that equity financing is better because the shareholders are very happy that the company remains invested only in equity share capital. हाँ अगर EPS के हिसाब से लिया हुआ है suppose, तो आप कहेंगे debt financing better है. हाँ तो question में आएगा अगर suppose the P ratio remains the same. For example, if the risk of the company is not going up, suppose I say that the P ratio remains the same, all the situations. Suppose this is the scenario. Now we know the share is highest in the case of debt. देखो इस केस में क्या हुआ कि शेयर होल्डर्स को कोई फर्क नहीं पड़ता. शेयर होल्डर्स ठीक है, कंपनी ने पहली दफा डेट लिया, छोटा सा डेट है, 10 lakhs equity है, only 2,50,000, a small amount of debt the company has taken, and company is very stable and doing very fine business, and is not, their profit is not volatile. They are into model of business which is not going to impact their profitability. The shareholders may like it, so they said okay, the rating remains the same. So in that case you will find the shareholders will opt that they'll say okay, company should go for a debt financing. But agar suppose company risky hai, agar aisa se, so it is like 8 and it is 7 here. Suppose it is like this, the equity remains. Abhi answer mila hai, or so now watch out P ratio in your question. P ratio is going to decide about which source. Any further questions? अब question आपका जो होगा ये होगा. Fine, doesn't require any explanation. The factors in deciding capital structures. Just hold on. Factors. What are the factors which decide about the capital structure of the company? First is control. Now, if more shareholders, like suppose I'm a promoter, I'm holding 100% shares of the company. There is no other person outsider. Or suppose maybe 20% shares are held by the public, 80% shares are held. So I'm firmly in control of the company. 20% shares are with the public, so they can't decide about the company. I am has the highest voting rights. Now suppose I bring more money, what will happen? My shareholders, shareholding will get diluted. So I am going to lose control. Suppose after the new structure has been formed, my capital ratio comes to about 40%, and 60% of the shares are held with the public. Still, I am having a majority stake, but some people can buy the shares and gain control of the company. Then I will be out of the company. So the control is very important. If you bring new shareholders, you are going to lose control. Now, there are startup companies now, particularly. When the startup companies are there, there are promoters who spend a lot of, time and effort to bring the company, and the company becomes a unicorn one day and start producing, a lot of, becomes a $1 billion company in terms of market cap, and company is doing well. So the promoters, till the time, they have to, before the company become big, they have to do various kinds of rounds of financing. They have to bring, people like venture capitalists, put money into their business. So as the, venture capitalists and people are putting money, they're losing their share, they're diluting their shares because their shareholding is dropping, and the shareholding of the venture capital is going up in the company. So they always have a fear of losing the control of the company, because sometimes the some people can think the company is very good, so they can kick out the promoters and they take over the hold of the company. They can do that. So to prevent such kind of an event, what the SEBI has brought, that whenever a company is coming, such company is coming for an IPO, when the company wants to raise now money from the public, okay, they come and raise the money through an IPO. They offer shares to the public. Now, the shareholders, the promoters of certain, kind of companies, which are, more in technology, nanotechnology, or, some other, company like Zomato or Paytm, such kind of companies, they have given rights. One provision has been made in the, rule, that they can issue, they can have, higher voting rights from the ordinary shares. Each shareholder has one share, one voting right. Now, instead of having, that they can have one share and five voting rights. That means one share will have five voting rights. So they can pass a resolution in the company and allow the promoters of such company, okay, to have more than one voting right. So they will have five voting rights. Okay, fine. So their voting rights go up. Okay, and even if they're bringing more share capital by way of either the venture capitalist or from public, so even if the shareholding dilutes, still they have power to remain in the company. So such provision is applicable for the first 10 years of the company. In a period of 5 years, this has been given. For the 5 years, they're given this extra voting rights. Then they can, again they won't, they can give another 5 years extra voting rights to themselves by passing a resolution. So for 10 years, they're given a full protection, that even if they're holding less number of shares, maybe 10% shares, but if their voting rights are 5 times, so they have almost like 50% of voting rights, so they can't be kicked out of the company. Is that okay? So that is only for the companies which are in technology companies, digital companies, or companies who have 1,000 crores or less market cap. Now this right is not given to companies like Adani's or Reliance, Ambani's or big companies. These are given only to the small companies which have which have grown up from the ranks, mainly as a startup companies. So to protect them to losing control of the company. Is that okay? So control is very important. Second is risk. Now, as you bring more and more debt, the risk of the company goes up, because you have to service the debt. And bad times, if you are not earning money, okay, so the company can go into liquidation, because if you are not paying your interest, so shareholders, the bondholders will, or the companies, the banks who have given loan to the company, they can seek for a closure of the company. Okay, they can go to the court and seek for binding of the company and get back their money. So risk is there when you issue share capital through debt. Then the cost. As you know, the equity is costlier and debt is cheaper. So it is always makes, case for making more and more debt, but only to the extent it is desirable and the company can withstand that debt. It should not be that the company has far exceeded debt. For example, recently Adani companies were supposed to have, still they have a lot of debt in their books. Okay. So they were being criticized that the company can, be in big, mess if they are not able to make. But the companies are doing well. They are the highly profitable companies. So as such, they're not affected. So cost is another factor. So basically, it's again the valuation game. What kind of source of money will actually increase the value of the company. The value of the company, suppose the company can, company has a very, very little amount of debt. So the company takes debt and, a company is expected to do well. So the shareholders' profit will magnify, okay, and the company's share value will go up in the market and it will increase the value of the company. Okay, so your overall decision, which source of capital to deploy in the company will actually, cause a shift in the valuation of the company. So whenever promoters or the directors of the company decide, the source of capital, they have an eye on the valuation of the company, how it is going to impact the value of the company, because every company wants their value should go up. So the valuation is very, very important. So the valuation aspect is always considered in great detail by the companies which are raising money through debt or equity, whatever source. So they should have an optimum capital structure which generates the highest valuation for the